So when we have to measure, here we are measuring the value of the GDP of the country. But measuring the value of the GDP of the country does not give us an accurate figure of who we are within this economy. So the country might be doing well, but what about the people in the economy? Are they doing well? How are we going to measure that? We cannot measure it with GVA, GDP, or GNI, or GNP. We can't, because we are talking about individuals living in the economy. So to measure the living standards of people within the economy, we have to use total or per capita GDP. That means we are measuring the national income of that country based on the total population. Get it? When we have to measure the living standards of people, or the living standards of Libyans versus the living standards of Turkish, when we have to measure this, we cannot use the real GDP to measure it. We cannot use GNP. We cannot use GNI. We cannot use NNI, because these ones are value of what is being produced. But we're talking about how we live in this economy against how they live in the Turkish economy. So to measure that, we have to measure it national income divided by the total population. So that's why I wrote national income per head or per capita is national income divided by total population. We're talking about national income, we're talking about the value of what is being produced in this economy divided by the total population of the economy. I think that is clear. Then we have transfer payments. When we are measuring, we have measured the national income through the GDP. We have measured the living standards. But when we are measuring the national income, there's something we must not measure, we must not add to it, which is what? Transfer payments. So what is transfer payments? These are amounts of money we get that we did not produce any output for. That's what we call transfer payments. Listen, transfer payments means you receive certain amount of money without you producing, without you servicing, without you doing anything. That's what we call transfer payments. So look at what I wrote here. When measuring the national income of a country, transfer payments are excluded. Why? Because these are payments received without any output. Without any output in exchange in a given economy. So here we have received certain amount of money without rendering a service, without producing a good. So when we are calculating what the country has produced in terms of output, we must never calculate it with transfer payments, because these are payments like a gift. So it must not be calculated. So what are the examples of transfer payments? One, we have children receiving pocket money. Yeah, you come to school, you have your dad gives you money or your mom gives you money. You did not work for that. So it is not considered as part of the economy. Two, welfare payments from government, like unemployment benefits, the wedding anniversary or the wedding payments that the government did. These are transfer payments. It's not included in the production of the country. So it should not be considered as a national income. And also, when you sell your used car, a used car, you sell it, you get the money, but a new car is not produced. Because a new car is not produced, it should not be considered as part of our national income. I think that is clear. So that's why when we are measuring our national income, for government spending, the aspect of government spending, we take public expenditure minus spending on benefits and grants. Grants and benefits are things we get from government without we working. So when we are calculating what government has spent in the economy, we must take away benefits given to us or grants, that is free money that we are not paying loans on. We have to take them away when we are measuring our national income or GDP. Note that GDP is government spending plus consumer spending plus investments plus export minus imports. So when we are calculating that item for government spending, it has to be public expenditure. That's amount government has spent on infrastructure, amount government has spent on roads, amount government has spent on electricity, amount government has spent on communication. All these things has to be taken away from the amount of money government has given to us without us working. Infrastructure will bring about production, will bring about encouraging multinationals to come in. So government spending on infrastructure will be considered as an investment on capital goods. Do you get it? So here, whatever government has spent to ensure that goods and services are being produced or provided in this country, it is part of public expenditure. But whatever government gives us freely, without we working for them, we have to take it away from what government has spent. That is how we can have our national income. So I'm going to quickly do the recap. Another measurement for national income is net national income, which is GDP minus depreciation. Depreciation is the wear and tear of an asset. So the value of whatever we have produced, those items, those capital goods that we use in producing them, they start depreciating. So we have to take that value away from the GDP. That is NNI. Then we have the volume and the value of national income. The volume of national income is the amount of money we have to buy the basket of goods. And what is basket of goods? It represents consumer spending. That means with the basket of goods, we can track the changes in the prices of goods and services we buy from the last year to this year. Then the value of national income, the value is the cost of the basket of goods we buy. So to measure the value of national income, it is volume of national income multiplied by the current price level. That's the price level at this point. Then we talk about economic growth. There's always a rate in change of economic growth, and that is the real GDP. The real GDP is when you calculated your GDP with your inflation. Then we have total and per capita income. This is measuring the living standards of the economy. We cannot measure the living standard of the economy using GDP, using GPA, using GNI, using GNP, using NNI. We cannot, because these things are true value of what is being produced. But we're talking about how people live, how people spend within an economy. To measure how people spend or live within an economy, we use GDP per capita or national income per capita or per head. So the formula is national income divided by total population. The value of our GDP divided by the total number of people living in this country. Then transfer payments. That was the last thing I talked about. Transfer payments means government spending on grants, government spending to us, for us, without we producing anything. Example of transfer payments is the money you get, the pocket money you get from your parents coming to school. You did not work for that. It is considered as transfer payment. When you sell your used car, it is considered as transfer payment. Though you receive money, but because selling of that new car, selling the used car does not create a new car, it is not considered as part of the economy. So that's all about measuring national income. So in the next class, we're going to talk about why do we measure the national income, I think. Yeah, why national income is measured. So we stop here.